Thank you all for joining today to engage with our webinar on PCN incorporation. This is a joint presentation by VWV and RSM to cover both the legal and tax financial aspects of PCN incorporation. We will be running a poll which should be being made available to you now, so do please provide some feedback on that. We will also be following up with our joint handout covering some headline issues for PCN incorporation. And that will be made available on request. We have a 1 hour slot today. We have previously ran this topic back in November and followed that up with a Q&A panel session in January. So today's session is a sort of halfway house, so we've got half the time of that dedicated towards our presentation, with the rest dedicated to your questions and hopefully our answers. We have compiled some of the most commonly asked questions we receive on this topic, so we can cover those at the end if we have time, or if everyone is too shy to raise any questions. Of course, if we run out of time, or if you'd like to speak to us privately, we are, of course, happy to take those questions by email or phone. If we could go on to the first slide, please. So just by way of introduction, my name is Mark Jarvis. I'm a commercial corporate partner at VWV, and I lead our London healthcare team. As I mentioned, I'm joined today by James Gransby of RSM, who will introduce himself shortly. Next slide, please. So just by way of recap and background, just a reminder about PCNs. They are a creation driven by a commissioning strategy to have GP practices working at scale to deliver specific services and to engage new clinical roles to free up GP time to deliver core services. PCNs themselves are not a legal entity, but are more akin to a contractual joint venture. And this was based around the fact that the network DES was commissioned as an enhanced service, which essentially bolts on to individual practices' primary care contracts. Its governance was a network agreement, which was mandated by NHS England, but the schedules of those agreements were intended to be locally tailored by member practices to reflect how they work. The key issue around the employment models was, at the time, there were a number of different employment models being suggested in respect to employing the reimbursed roles. Those included the lead practice model, where one practice would employ the members of staff, or multiple employing practices within a PCN. There was a joint employment model being discussed, where all of the practices jointly employed the reimbursed roles. One option was a super partnership, essentially where all of the practices in the PCN essentially is one practice. And the other option was the engagement by a third party, such as a GP federation or an NHS trust. There were pros and cons for each of those, with the cons mainly being related to VAT issues, access to the NHS Pension Scheme, and concern from some of the employing practices around the liabilities associated with that employment. Now, the PCN company model is perhaps more akin to the third party model because it is a separate legal entity. Of course, PCNs that are being already served by a GP federation might query the need for a PCN company, and this session it certainly isn't directed to direct PCNs moving away from whatever arrangements they have if they're working well, which have their own benefits which a PCN company may not be able to meet. A PCN company, by its nature, brings the arrangements inside the PCN fold. So in one sense, there's a comparison there between outsourcing and in-house provision. So why incorporate and why do it now? I mean, some of the main benefits mentioned above. A PCN might not have the support of a GP federation. One of the key benefits is having limited liability, and liability is ring-fenced inside a PCN company. And that can be measured against the unlimited liability that GP partnerships will have. Now, of course, the risk with a company limited by share models to its shareholders is limited to the value of the shares. A company vehicle has its own separate legal personality, so it's able to hold its own clinical and commercial contracts, which may become important as PCNs mature. The PCN company can employ staff, which is certainly likely to be its main function. And it offers a better base for having standardized employment terms. As a single entity, a PCN or PCN company as an entity can speak with one voice, which can be helpful when engaging with commissioners and other stakeholders as part of an integrated care system. Again, particularly where PCNs do not have the support of a PCN federation, which is already carrying out that role. As a separate legal entity, it's possible to delegate or to subcontract to a company, which again will work well as PCNs scale up, although you do have to be mindful of when the CQC registration requirements kick in. There are, of course, tax and financial advantages, and James will be touching on that a little later. We go on to the next slide, please. Again, so when I mentioned about why now, I mean, time was an issue back in 2019. There was very limited time to actually put together different vehicles and options. And one of the big hindrances around the PCN company was the lack of availability of the NHS Pension Scheme, because as a generalisation, it's largely going to be limited to entities that hold a clinical contract. But back in October 2019, provision was made by way of guidance for PCN companies to apply for what's known as a PCN directional determination status, which was a bit of a game changer in terms of incorporation and removing that hurdle. The original guidance allowed that to run till March 2021. It has been updated over time with the current arrangements running till 2023. And certainly the expectation is that behind the scenes, consultations will be ongoing around the NHS pension regulations and perhaps codifying that on a more statutory footing. And James will discuss the application process shortly. So this session focuses on the company limited by shares models. Now, there are other corporate models out there. Many of these won't be as flexible or useful due to various reasons, such as tax or NHS pensions access or more burdensome regulatory requirements, perhaps even restrictions on the ability to take dividends or transfer assets. Now, we mentioned that we'll be taking questions at the end, but one question we received in advance was around the use of an LLP vehicle for use as a PCN corporate entity. Now, as always, when setting up any sort of entity, the choice of vehicle needs to be led by that discussion around form follows function. And there are a few reasons why company limited by shares are being chosen for this particular purpose. James will touch on the financial and tax reasons, but from a legal and regulatory perspective, I mean, certainly an LLP has that limited liability and that separate legal personality. But where the PCN vehicle is being set up to employ the reimbursed roles and doesn't have a clinical contract, there are issues around the availability of the NHS Pension Scheme. The NHS BSA guidance also only refers to a company, which on the face of it, for that particular route, would rule out an LLP. There is another route available, which James will touch on later, but that has its own limitations. It's worth noting that if an LLP does tick all of the other boxes, perhaps one of the first ports of call would be to approach the BSA to see if they were willing to make a determination. But again, it has to work for all of the other reasons as well. Another reason one LLP might not be, well, certainly considered not as flexible as a company limited by shares model, is that in terms of future-proofing a vehicle, you might want to, in the future, perhaps use the PCN as a service provider. And it's possible that commissioners, and certainly it's been discussed in some parts of the country, about commissioners carving out locally commissioned services to commission from a PCN entity. Now, one might expect that to take the form of an APMS contract or an NHS standard contract, which an LLP would be able to hold. So it might feel like there might not be an issue in respect of some of those. But certainly in terms of flexibility and opening up the potential future options, a company limited by shares is certainly the most flexible around that. We've even had one case of a PCN being asked to caretake a practice. And again, due to the eligibility requirements, an LLP does cut down the available options. So I think the takeaway from that is when you are looking to do anything, again, it's that comparison between different models against your intentions, your requirements, making a decision based on what best suits your needs. Moving away from that, again, onto the company structure, it's probably worth noting that the importance between the roles of director and shareholder, and this does come up a lot when we're assisting PCNs in terms of setting up PCN companies. We do cover this more fully in our handout, which I mentioned at the start, but it's worth bearing in mind the distinction between the two roles of director and shareholder, being that the directors manage the day-to-day affairs of the company, whereas shareholders, they own the business and they typically make constitutional decisions. Go on to the next slide, please. So although a company has its own legal personality and it is responsible for the decisions the directors take, there are some limited circumstances where directors could be personally liable, largely as a result of their statutory duties. Those beyond the scope of this session. In fact, it could be a very long session discussing those, but on the next slide, I've set up just a few major examples, which I won't go into here, but it's just worth bearing these in mind. It's also worth bearing in mind that companies can obtain directors and officers insurance, which can provide some protection against certain liabilities. Let's move on to my final slide. This is just about the practicalities in terms of company and ownership. Now, it would be expected that the shares in the company will be held by individual members, partners of the core network practice on trust for their partners. And this will very much depend on the size of the PCN and the size of the practices. Companies have some flexibility with them in that you can have different classes of shares. So you can separate voting rights and dividend rights in respect of different shares. And it's even possible to have dividends being dealt with by way of a dividend policy. So there is flexibility around its setup and its operation. In terms of its governance arrangements, company limited by shares is going to be governed by its company's articles of association. And as between shareholders, the shareholder arrangements will be governed by a shareholders agreement, which is likely, but not always, to reflect some of the terms perhaps you already have in your network schedules. Regardless of that, it will be important to be very clearly within that agreement around decision making and what decisions are going to be reserved for the shareholders. It's also worth bearing in mind that your network agreement is an agreement between, at its very least, the core network practices, but possibly other non-core network practice members. And consideration should be given about whether or not the PCN company should be a member of the PCN agreement. And that will require checking of the PCN schedules to make sure that wherever it's included, which terms you wish to apply to it and which you don't, and it needs to dovetail in correctly. In terms of directorship, again, this is likely to be impacted by the size. It's possible to have one representative per practice acting as a director, although perhaps with a larger PCN, you might want to have a smaller directorship in charge of those day-to-day decisions. The practicalities of setting up a company's house is relatively straightforward. Certainly we can assist with the relevant forms and the drafting of certain resolutions required. I mentioned those articles of association. Companies can be set up with model articles, but we would always advise tailoring those to reflect the actual working arrangements. We would do that the same way we would prepare a shareholders agreement or even a partnership agreement by way of a detailed questionnaire and using your responses to tailor those arrangements. So the other considerations and things to bear in mind around PCN incorporation, one of them is TUPE, where you're essentially moving a service inside a company which is taking over a service provision, which is considered a relevant transfer. It's possible that TUPE can apply to certain staff, meaning that you have to bear in mind the consultation process and the fact that they would transfer over on their existing terms. It's important to bear in mind CQC registration requirements for if the company is going to be provided a regulated activity. And also any sort of, if you're thinking about subcontracting, thinking about the relevant consents required under primary care contracts. If you are going to be entering into other arrangements, commercial or clinical, with other third parties, a reminder that it's always important to have these properly documented, along with any other arrangements, including director service contracts or employment contracts. The final point is just to bear in mind about ongoing compliance for running a company. It's important that certain things are logged at a company's house at certain points. If you don't have your own in-house secretarial services, both our VWV and RSM can provide support, which will avoid the PCN company falling foul of those requirements. So that's the end of my particular session. At this point, I'm going to hand over to James, who will summarise the financial and tax applications. Over to you, James.
Perfect. Thank you, Mark. Hello, everybody. I recognise some of the names on the call, so hello to you. And for those who don't know me, I'm James Gransby, a partner at RSM Accountants. We act for around 300 GP practices and over 1,500 GPs. I'm also the Vice Chairman of ASMA, the Association of Independent Specialist Medical Accountants. And my first slide really just looks at why we're here. Why are people looking at this as an option, PCN incorporation? And the first question was a poll. Let me just share the results of that poll because you were kind enough to answer that earlier. So hopefully you're now seeing that on the screen. It says that you are. So over 90% of you are building knowledge or actively assessing the option. The other 8% have already assessed it and now ready to go. So I'll stop sharing those results. And the reason that you're probably looking at this is potentially because of VAT. VAT is a bigger obstacle. PCNs aren't an entity in their own right. And although VAT has an exemption for healthcare, if you're providing a healthcare service, if you're supplying staff, which practices are in certain PCN models, then you may have a VAT exposure when that limit gets exceeded, which is £85,000 worth of staff. So that's a big indicator. Also, staff and liability in an unincorporated PCN, liability for staff. So, for example, any employment claims or redundancy payments at any point in time falls back on the individual practices. So it's a big liability to take on. And we'll see later that there's over £1 million worth of additional rolls money going into PCNs by year 5 for an average size PCN. So there's a big liability there, which can be mitigated using a company. And future contracts, if you wanted to be commissioned to run an APMS contract, for example, you couldn't do that in a PCN unless it had a company. So they're the 3 main reasons, the top one being VAT, which is the one that we're seeing a catalyst a lot of the time. Just going to move the slide on. So what it is not, this seminar isn't trying to incorporate GP practices for the avoidance of any doubt. I saw a GP Online article at the weekend talking about commissioning at scale and conflating that with the commissioning models in terms of corporates. This isn't about turning lots of GPs into corporates, far from it. In fact, I think the partnership model is definitely fit for purpose for GPs. The Nigel Watson review came to the conclusion, and I wholeheartedly agree with that. So this isn't about incorporating GP practices, which is usually a very bad idea for pensions and tax too. But what it does is it fixes the inherent issues with PCNs and certain models of PCNs in terms of tax. So let's just remind ourselves of the models. So here they were back in the day, back in probably January, February, March 2019, when you had to choose a model by July. You would have been looking at flat practice, lead practice. And as Mark said, for those using a GP federation and for those that it's working well for, you may not need to take any action after this seminar. You may already be in the correct model. But this is also the one that we're looking at if you set up a workforce company for your PCN. It's that option number 3, the provider entity model. Super partnership's different. So if you've got a practice already looking after, let's call it 40, 50,000 list size or more, then you may not need to join up with other practices locally. You'll be a super partnership for the purposes of PCNs, and it will just flow through just like another DES. So VAT is not an issue. Tax on surplus, all those sort of things aren't an issue for you. And in fact, you probably don't need to take much action whatsoever. And number 5, non-GP provider models weren't very popular community trust run PCNs. So let's look at number 3, which, like I say, was in the BMA handbook from the beginning. And here it is. This is what we've been talking about today, putting a limited liability vehicle. And we're focusing today on companies limited by shares. And I'll explain why in a moment, because that question's come up a little bit in the Q&As. So I'll explain why we're looking at companies limited by shares. But putting that above the PCN. So the PCN still exists as an entity. And in fact, the nominated payee will still be a lead practice in this model. So the money still goes in at PCN level, but you have a workforce company to house the additional roles reimbursement staff and potentially some admin staff up there as well. So this is a company that sits above the PCN. The PCN doesn't become a company for the avoidance of doubt. So right at the beginning, if it's such a good idea now, why didn't people use it from the start? And the big answer to that is the pensions access. So down the bottom there, the PCN handbook, it was talking here about, in the red box, unlikely to be able to access NHS Pension Fund unless it holds an NHS contract, which would be core GMS, PMS or APMS. And then it says that last sentence there, however, it may be that practices decide to develop under a different model with an expectation that they will change to a limited liability model once this, i.e. pensions access, and other potential issues are resolved. And the pensions access issue actually got resolved later on in 2019. and I'll explain a bit more about that. Mark's already touched on it earlier. And again, NHS England, were they consistent back in July 2019? Yes, here it says members of a PCN may in due course wish to form a legal entity. So in a large way, this is a natural evolution for PCNs. I've written a Pulse article which explains how that evolution has evolved from July 19, when maybe your PCN had a social prescriber and a clinical pharmacist, to now possibly having many, many more additional roles, people coming through, and a lot more money coming in. So natural evolution that people would think about companies. And in fact, on the courses that I went on right at the beginning, everyone predicted companies at some point with the VAT being a catalyst for it. So why not before now? Scaling up, I've already mentioned the number of staff employed by PCNs has really exploded over the last particularly 12 months, but definitely since inception in July 19. Longevity, I think it was about this time last year where people were voting whether to carry on with the DES or not, and there was a question mark, but then there was 98% take up. So it's got longevity now, and it's around, and certainly part of ICNs and the white paper. So here to stay. And the previous pension issues being a major obstacle. Scaling up, as I alluded to, so 50,000 list PCN, which is slightly above average, but it was the target sort of size. So this current year, £618,000 worth of staff available to a 50,000 list PCN, nearly doubling in a couple of years' time to 1.1 million, if you can find the staff. But assuming that there are opportunities there, then there is a lot of funding available to you. Now, I mentioned VAT more than once and why that's an issue. And what does a company fix in this sense? What it fixes is it allows you to operate a VAT cost sharing group and benefit from something called the VAT cost sharing exemption. You can't do this without the separate company entity. An LLP qualifies. I'll explain more about LLPs in a minute, limited liability partnerships. Companies limited by shares qualify. So you can have a VAT cost sharing group. And as I said at the beginning, if you're supplying a healthcare service, that is covered by a VAT exemption. But really, when you're working within a PCN, it's the staff that are moving around. It's all to do with direction, supervision and control, and who coordinates the staff when they're on the ground. So rather than trying to convince HMRC that you're providing a service and trying to call an apple a pear, if you accept the fact that you are supplying staff around the system and you have breached the £85,000 limit, then you can set up this VAT cost sharing group, which means any staff working within the workforce company, the PCN company, can work for the GP member practices and certain conditions, as long as all of the members of the PCN are the PCN members as well, and you're not recharging at a profit, which is fine within the additional roles refund mechanism, then you can exempt those supplies, so you don't have a VAT issue popping out. Now on this slide, I was talking about limited companies limited by shares and how we'd set those up. Let me just first turn to this limited liability partnership question, because it is a hot topic and I've seen other articles on it actually. Now, good news, let's start with some good news. LLPs, it will fix the VAT problem. You can have a VAT cost sharing group in an LLP. So big tick for that one. Second one though, not so good, NHS Pensions access. Because LLPs are forbidden to hold a GMS or PMS contract, that in itself means that it can't become a classic employing authority. You can't have classic APMS employing authority status, so it needs to go down the independent provider route. Now, a couple of the problems with the independent provider route is that pensions access is only for those who are working more than 50% of their time on services under the core NHS standard contract, so they have to work more than 50% time in PCN DES work, which may not be a problem, but there's also a 75% pensionable earnings ceiling as well. So the preferred route for pensions is a limited company, because then you can get this determination direction status, and I have applied for this for PCN companies and it has been accepted. There was a question earlier as to how many have been accepted. I don't know the full quantum nationally, but I know that it is definitely possible because I've done it and I've seen it come through. And there you don't have to worry about the 50% rule that you have equivalent to employing authority status. So that's the second thing on limited LLPs, restricted NHS pension. The third one, LLPs, reason why it's not such a good idea. One of the things that the company model does fix, the limited company model fixes, is this tax on surplus issue. As you build up surpluses in your PCN each year, if you don't spend all of it, currently, if you haven't got a company, that's going to get taxed back on the practices at marginal tax rates of the doctors, so 40 or 45% in nearly all cases. If you're an LLP also needs to be taxed on its members, and its members will be human beings, natural people. There'll be the GPs again at 40, 45%. So it's missing an opportunity to shelter that surplus away from tax if you have an LLP. And in fact, I just did a quick search knowing that this question was coming up. I did a search on Companies House earlier, looking for companies with PCN or primary care network in the title, which were clearly Dr. PCNs and not just someone with the initials. And I could only find there was about 150 or so companies which have been set up for PCNs so far, and I could only find one LLP. That LLP was up north somewhere. When I looked at their incorporation documents, it was clear that to me that there wasn't really a solicitor or an accountant involved. It looked as though they'd done it themselves, so maybe they hadn't quite understood the pensions and tax issues, or maybe they had a certain set of circumstances, I don't know. But it's telling that I could only find one LLP, whereas there are well over 100 PCN limited by shares companies. So talking down the limited by shares route, how would that be set up? And it looks quite similar to how a lot of federations would have been set up back in the day. So class of share, so that's why we've got A, B, C there. Class A shares, let's call it, for voting. So it could be one practice, one vote. And then another class of share, usually based on list size, in case there's any surpluses to pay out, either as things go on or at the end of the company life. Because funding for PCNs is largely determined by list size, as you'll be aware, then you'll have a class of shares based on list size for those distribution purposes. So that's how it would be set up, and the limited versus LLP argument. A couple more slides and then we'll go straight to Q&A. What's the rush? Mark's already said it, and I've said it a few times already. VAT is the catalyst for many as that workforce really ramps up and exceeding the £85,000 limit. As soon as that is breached, then the practices who are supplying staff, could often be the lead practice first in the firing line, would need to charge 20% VAT on the supply of staff, which would then be irrecoverable for the receiving practice. I know we've got issues with dispensers that may be VAT registered as well, but VAT will be a leakage in the system. The other reason, before the staff burden gets too large, if you know you're about to employ lots more staff in the coming year, then it's a good time to do it now to stop too many people having to be TUPE'd and transferred over from the existing entity into the company. Before bidding for contracts, that's if you're looking to hold an APMS contract, for example, and I think that was part of the news article last week. You wouldn't be able to do that unless you were a company at PCN level. Unlimited liability I touched upon, and Mark said it too, in terms of the staffing particularly. That governance structure, the Companies Act 2006 being a framework within which to run your PCN, as opposed to that PCN network agreement, which isn't a fully functional governance structure. And then staff having that single master as well. I've had reports that in a 5-practice PCN, there was a staff member who seemed to have 5 different employers, wasn't quite sure who they were employed by, and nor were the practices themselves. So having a separate workforce company gives that structure around the staff as well and who their employer is. Of course, there's always some downsides, one being cost. So the cost of forming one of these PCN companies would have to come out of the £1.50 money or any other surplus that's available. And the extra layer of bureaucracy means that you would present your accounts at Companies House each year in an abridged format, so we wouldn't be able to find out too much on public record, but there would be transparency there, and you would need to file accounts and corporation tax returns and so on. So what's next? Doing exactly what you're doing today, and coming on to seminars like this to understand more. Mark and I are both very happy to join, especially with Teams and Zoom. It's very convenient for everybody. If you had a meeting coming up, happy to join on that and either present this session again for those, and we can do a shortened version of it for those who aren't here today. We could do board papers for people, but generally haven't had to do many of those. If anybody's interested in the Pulse article I mentioned earlier, I can send that through. So assessing the option number one. If you then assess, and like 8% of people on the call have already assessed and realised that you need to do something now, then it's about taking it to the next stage, forming the company, VAT cost sharing group advice, setting up corporation tax, PAYE schemes, pension determinations, etc. And one of the minor headaches, but it isn't too bad, is setting up a new bank account for the company as well. In conclusion, you need to make the decision at your own pace. Not every PCN will need to do this, especially, as Mark said earlier, the ones that are using a federation very well at the moment don't need to think too much harder about this, and those in super partnerships don't either. And make the decision that's right for your PCN, not because neighbouring PCNs are doing it their way. They may have different circumstances. So become informed and work out what's right for your PCN, and we're here to help you make that assessment. So we'll go into the Q&A now. There's just, and as Mark said earlier, there is the free handbook. So contain your excitement. We will give that away for free for anybody that's attended the course, and we'll get in touch. I'll stop sharing, and then we'll move straight into the Q&A.
Great, thank you so much both. Really informative presentations. But we've got quite a few questions in the Q&A box, so I'll just start going through some of those. So first one, which I think you might have touched upon, but maybe just for clarification, can you please indicate why limited company is preferable to an LLP? Is it just the profit-making question? They're assuming that limited companies are better than federations and super partnerships, as these themselves are akin to partnerships.
I probably won't spend much time because that question came in quite early, and I think I spent a fair bit of time. So just a summary: fixes VAT, bad for tax on surplus because that comes out to the members, bad for pensions. So all in all, not a great idea for an LLP. And so companies trump LLP. I don't know if you wanted to add anything, Mark. I think you mentioned it in your piece as well, didn't you?
Yeah. I think that's pretty much the main reasons around flexibility and some of the financial reasons.
Great, thanks both. So next question, are you aware of how many organisations have been accepted as NHS Pension Providers?
On Companies House, if they're around about 150 or so PCN companies, you would imagine that there's probably 150 or so that have asked for NHS pension status. As I say, for the ones I've done, I've had no obstacles. It's had to go up through the chain of command, but it's been approved. That question actually, Lucy, made me think maybe it's time for doing a freedom of information request. Maybe might be able to get the answer to that one. So yeah, I might think about doing a freedom of information now that they're up and running. But yeah, I haven't had any problems doing that.
Great, thanks, James. When you talk of a company, what form of company are you referring to? Company limited by guarantee, by shares, community interest company?
I was just wondering if Mark wanted to comment on the limited by guarantee versus limited by shares. There might be terminology that people aren't familiar with.
Yeah, I mean, I suppose the key points to bear in mind is, yes, it ticks that they tick the box for the separate legal personality and the limited liability. The issues from a regulatory, I suppose, a legal perspective is that the company limited by guarantee takes you outside the ability to hold certain primary care contracts, and which means going down the APMS classic employing authority route would be out of the picture. A lot of the models, I think the issue is also around company limited by guarantee is around the ability to share profits. So I think that it perhaps doesn't lend itself towards this particular route for financial and other reasons. And certainly, although the BSA guidance only refers to a company, as I say, because of those other restrictions about the classic route, it doesn't seem to be as favourable an option. CICs, again, you can have a community interest company either limited by shares or by guarantee, and a CIC company limited by shares would work, and it is appropriate for certainly a number of federations to set themselves up, and it works well for the reason they're setting up. I suppose the issue around a PCN companies, where it has a limited purpose, you have to ask yourself why you would want to go down the route of the additional regulatory requirements around CICs, making those annual reports, ensuring you're complying with that. Really, at this stage, if you're just focusing on having an entity for the employing the roles, taking on additional requirements and restrictions doesn't see that there would have to be a very good reason to want to go down that route. But certainly, a community interest company limited by shares would work.
Great, thanks, Mark. So there's a cost involved in setting this up. Do you have an average on that cost?
Yeah, from what we're seeing, if you combine accountancy and legal fees together, it comes in around about £10,000 plus VAT. Being totally open about it, that's what we're finding. And as I said earlier, that probably comes from your £1.50 money, any unspent element of that, or any other surplus that comes out. Once it's set up, it's a one-off cost to set up and get the advice around VAT, cost sharing groups and legals. And then the ongoing cost annually of doing company accounts versus your normal PCN accounts may be around double. So whatever you're paying to get your accounts done, it may be, expect for it to double in a company. But yeah, around about £10,000. And I think a couple of people asked that question. So I'll click done on those ones as they come through.
Perfect, thank you, James. So will each PCN be needing a company, or can one company govern 4 to 5 PCNs in the same area?
And I think the answer to that is looking at each question on its merit, each one on its merits. So in fact, we have formed some companies for multiple PCNs. Depends how closely you're working together. And in fact, the NHS England FAQs, the slide that I shared earlier, was talking about this concept of a mini federation in quote marks. And when you've got that many practices, 4 to 5 PCNs, you're kind of setting up a mini federation in a sense. But really, you're not doing it for the normal reasons that you'd set up a federation. Largely, it's to get around the VAT issue and the cost sharing group and being able to set one of those up. So if you're working very closely together, then it could be right to have one company. If you think that at some point, 1 or 2 of the PCNs may wish to go a separate direction or have different ideas and objectives, then it may not be a good idea to all go in one company, because there needs to be a common purpose, a common direction. Mark's probably certainly got something to say on this as well, I'm sure.
Yeah, I mean, again, you're moving yourself in the direction of either possibly duplicating what a GP federation. I mean, perhaps if there isn't a GP federation in the area, then that might be a route. But again, as James has said, it's important to think about the purpose, the direction you're going, and what it's going to be used for, and where you see it going. Certainly as part of ICS and potentially other options for bidding for services, about whether or not you see that as that sort of structure, almost as a federation structure, rather than a company that is just mirroring the members of a particular PCN who are already working together in that under that sort of network agreement arrangement. So it probably can tick the box for some of these purposes, but it's about what you want to do with it going forward. Does it need to be on that scale, or does it, or can it just be on a per PCN basis?
Thanks both. How does VAT cost sharing work if a couple of practices are VAT registered?
Yeah, so if they're VAT registered, it's no problem. In fact, the VAT cost sharing exemption, when it was first sort of invented, would be for mostly VAT registered businesses. So the fact that GP practices are predominantly not VAT registered doesn't matter. So if you do have some dispensers in there, the cost sharing group, and in fact, a couple of the PCN companies that we've set up has dispensing and non-dispensing, as you might imagine, and it's absolutely fine. And whilst we're on the subject of VAT, the next question is about VAT, so bundling those two together. I'm just going to share screen again, because somebody's asked about this slide and wondered why member 2 didn't have that exemption. And it was simply because in this diagram, we were talking about the flow. So if you look at the flow of staff coming down from the PCN company to member 1, it's staff working from the company to the practice, which is exempt. But if member 2 decided to apply some of its staff members to the PCN company, so let's just say there's a practice manager at member 2 with some spare time available within their week. Not many practice managers with too much spare time, but let's take it forward on that basis. If they're supplying that person to the PCN company, then that is exposed for VAT as a supply of staff. So it's really looking at the arrows and the flow. That was simply the reason behind that one. Oh, I didn't share, did I? I do apologise. Or did I? So yeah, it's just that flow between the two. So that answers those two.
Great, thank you. And so is there a guide cost for setting up a limited company, just as a guide?
Yep, so that was all built into that figure that I mentioned earlier, that 10,000 would include the company setup as well.
Perfect. And can you explain the process for accessing the NHS Pension Scheme as we hold an APMS contract now?
Okay, so if you hold an APMS contract now, you may wish to look at the employing authority status if you're a limited company, because if you don't have an APMS contract, you have to go down the direction determination status. There's a form which I've got, there's a link you can find through Google, there's a form you can do online. If you already have an APMS contract, then that's even better. You can apply for employing authority status in a lot of cases. Happy it's an anonymous attendee, but if they wanted to send me an email afterwards, I'll be happy to talk them through that one.
And it's worth perhaps just adding the distinction about having an APMS contract. It's also around the ability of the company, which route you take is in terms of your setup. If you were the sort of company that was eligible to enter into PMS and GMS, you can go down that classic APMS route. But if you weren't and you held an APMS contract, you're limited to that independent provider route that James mentioned earlier.
Great, thanks both. So if you're already a super partnership or federation, is setting up a company more beneficial than setting up as a federation or super partnership?
If you're already a super partnership, you may not need for your PCN purposes. If you're already a super partnership, if you've already got that list size that's big enough to have a PCN in your own entity without having to set up another company and without having to join up with other practices locally, then you don't need a company. It's another designated enhanced service. It's another DES that flows through your practice. So you don't need to, which could be the best news you've heard all day. You can just allow it to flow through your practice as a DES. Any other comments on that, Mark? I think that's pretty much.
No, I think that's the key point, really. I mean, it's whether or not a super partnership, but whoever wants to move towards incorporation, I mean, that's a sort of different set of questions. It's about whether or not incorporation is right for that practice. But setting up a separate vehicle to sit alongside what is essentially a PCN, which fits as a dotted line around the super partnership, it wouldn't generally be needed.
Thank you. And next question, you mentioned tax benefits for company limited by shares and that they can shield surplus from tax at doctors' marginal rates. Can you explain the tax savings?
Yep, certainly. So at the moment, the PCN in itself isn't an entity in its own right. So the only way it can report its figures is through its constituent practices. So if you had a 4-practice PCN, for example, you need to, and it made a £40,000 surplus and everybody was equal list size, each practice would need to report its £10,000 worth of the surplus through its own accounts. Otherwise, HMRC aren't getting any tax on that surplus, and they're keen to do that. If anybody was at the Birmingham event on the 8th of February last year, then they will have heard from HMRC that there is tax on the surplus. Now, if you set up a company, the company is subject to corporation tax rates, and based on profit levels in a typical PCN, that would be 19%. Maybe going up slightly with a chancellor's increased tax, but up to 25%, but 19% would be it. There may also be the opportunity to benefit from something called a mutual trading exemption with members, where surpluses can go up to the company and not be taxed in the company until such time as they come back out to the individual practices. So worst case scenario is 19% corporation tax. And with advice and looking at your particular circumstances, you may be able to shelter some of that surplus so that it only gets taxed at the practices when it gets distributed. So that's the answer to that one.
Great, thanks, James. Just checking the time. Yeah, we've got about 10 minutes left, so I hope we can get through a few more questions. What percentage of PCNs are having limited companies? Must be many without having to form a limited company.
Yeah, so total number of PCNs in the country is about 1,250. Like I say, I found it was about 3 or 4 months ago I looked, and there were just over 100. Now there's about 150 or so at Companies House. So a fair chunk, more than 10% are now. Others are probably in the pipeline. If I was a gambling man, I'd say that over half of PCNs will probably end up having a company, particularly if you think back to that slide, over £1 million worth of staff going through PCNs by year 5. Things are really ramping up this year. We're seeing lots more additional role staff going into PCNs in this current year. This will be the time when a lot of people decide to make the change, having reached maturity in terms of number of staff that they're employing, and that VAT issue not having been overcome by HMRC up until now. And to be totally frank, if it wasn't for VAT, if it wasn't for the tax on surplus issue, then we probably wouldn't be here today. There would be the exposure for limited liability for staff in GP practices, but then is that so much different to a normal GP unincorporated practice? Maybe not. So it's the tax issues which weren't thought about fully, I don't think, on inception of PCNs, which are a catalyst for people having to set up these limited companies now.
Thanks, James. And if PCN practices form an LLC, but then in the future decide to merge, will unpicking the LLC be complex?
Did you want to take that one, Mark?
I suppose the first question is that, if you're looking to merge, the question will be, what do you want to be going forwards? It might be that you want to be a corporate vehicle, in which case you might want to utilise the company that you set up. But if you're sort of ending up as a super partnership, and you need to sort of, as you say, unpick the limited liability company, it will be sort of treated as if you were doing a sort of an acquisition of sorts. You'd end up be bringing that back in house. The TUPE would apply. The company would need to be closed down, and all of the if there were any assets in the company, they would need to be transferred inside. It wouldn't be complex, but it's just a process that would have to be gone through if you no longer needed that limited liability company, and also. Yeah, I think that's pretty much the way you would approach it.
Great, thanks, Mark. So next question. If you're the lead practice within the PCN and you're not VAT registered, does the vatable income / reimbursement of the ARRS go against your total vatable income, or is this split between the PCN? They're very conscious that they're not the lead surgery and they're not currently VAT registered. In
short, the answer is yes, anonymous. It gets added to the lead practice's turnover for that purpose. So if you're employing all of the staff and they're being used by the other practices, then it's often the lead practice that's the first one that needs to assess their vatable income to see if you've gone over the £85,000 limit. So you'd build in other vatable income that you may have, medical reports that you're doing for solicitors, for example, and other things. There's often some other VAT-able income in there, but you'd need to assess that. Obviously, we'd be happy to assist. I've got one of our VAT specialists who's in the audience at the moment attending, but he'll be happy to chat afterwards. It sounds like you might need an assessment there.
Great, thank you, James. And if you're set up as a company that enables the PCN to employ its ARRS staff, and those staff can receive an NHS pension, will that mean that all that company's staff have the right to be paid the pension? They're asking because many staff without the NHS history are not interested in an NHS pension. Sorry, tripping over my words. An NHS pension, and it creates a huge overhead.
So the PCN workforce company, once it gets that determination direction status, then all of the staff within it would be able to access the NHS pension, is the short answer. The LLP is the one that's a bit more problematic, because that would need to have people working more than 50% of their time There's also that cap for pensionable earnings ceiling. But yes, any staff working in the PCN in that workforce company would have access to the pension under the determination status.
Thank you. And someone's asked, are we aware of the practical considerations? So, for example, would the company need independent insurance, assurance, indemnity, accountancy, health and safety and risk assessment policies? Or would these areas still be covered under the current network practice agreements?
Mark?
No, and it's certainly in terms of, it depends what it is it's going to be doing. I mean, if it's providing certain services under subcontracts, it may well be caught by the GPA indemnity scheme. But in terms of employment of staff, yeah, I mean, it's going to be needing all of the appropriate insurances and policies in place, and certainly in respect of accountancy. I'll let James comment on that one.
Yeah, well, you'd need to do a set of accounts for Companies House and corporation tax returns, annual returns for the company as well. That's something that an accountant would be able to certainly look after for you, so it's not too much of a burden. But yeah, it is making sure that you've got all of the necessary insurances and documents in place, the same as any business really.
Thanks. I think we might just have time for one more question. Someone's saying they have a provider company owned by all practices. Could they become the overarching workforce employer, and would they have to hold an NHS contract to access the pension?
Okay, so two parts to that question. One is, there's already a company owned by all the practice. Can they become the workforce employer? Possibly, yes. They'd need to be brought into the network agreement, and Mark may have something to say on that in a second. So yeah, they need to be bound within the overall PCN. And do they have to hold an NHS contract to access pension? No, they can apply for that determination dispensation status to be able to get the access to the pension. So Mark, in terms of the practicalities and binding them into the network agreement, did you want to pick up on the legal side on that one?
Yeah, I mean, if you've already got a company that's set up that does the job, it's worth bearing in mind, obviously, that the company shareholders agreement's been properly tailored and it's reflecting how you're actually working. So I don't know whether that's a dormant company or one that you're actually using and whether it works for that purpose. In terms of bringing them inside, again, it's having a look at those schedules. First of all, they need to be applied to be a member of the PCN, but it's worth. And that includes all of the other arrangements as well, the data sharing arrangements that are in place between the PCN members. But it's just ensuring them as adding them a party, going through the usual processes with the CCG about adding them, ensuring they're bound to the terms of the network agreement, but also being very clear throughout the network agreement. For example, where it refers to members, you wanted all of those provisions applying to all parties, but specifically where you want certain things, for example, decision making or other things only relating to certain parties, you'd want that to sort of refer to core network practices. So relatively easy to do, but just to make sure that it's been updated to reflect that.
Thanks. I'll just try and squeeze in one more. Regarding staff liabilities, can this be mitigated by offering fixed term contracts?
I certainly think in terms of ongoing, I'm not an employment solicitor, but in terms of ongoing liabilities, but obviously certainly having fixed term contracts brings that liability to an end sooner, not an ongoing contract. But it's really, I suppose, around liabilities whilst they're employed. The ring fencing of the liabilities inside a company is one of the benefits of that vehicle. But yes, you can mitigate it in that way.
And I think one of the things that a lot of PCNs are worried about, especially in the early days, is employing all of these staff for a DES, which is a time limited 5-year contract. What happens if the DES doesn't continue after that 5 years? Well, they have to make everyone redundant, which would be very, very pricey at that point in time. I think there was some consolation given and some answer given to this nationally, in that they would try to find other places within the system, within the ICS, for example, for all of the staff under GP, so that it wouldn't become such a major issue. I think PCNs are here to stay. They're very much hardwired into the white paper, and so hopefully that wouldn't ever come to fruition. But yeah, I think nationally there would need to be something done, as opposed to looking to each individual PCN to fix it.